Alrighty, where this story starts out is very important, right here, okay? So, if we look at the past 3 CEOs for Nike, we had this gentleman, Mark Parker. Mark Parker was a CEO from 2006 to 2020. Now, Mark Parker had previously been the co-president of the company. He joined Nike way back in 1979. He worked various roles, and he worked his way up the ranks over time. He was an internal hire, and he did a phenomenal job. Nike's revenues and profits skyrocketed during that particular time frame, okay? And the stock price skyrocketed as well. Did a terrific job. Elliot Hill just got brought back into the company. He was at Nike for 32 years. He got passed over to be CEO. I don't know why the board of directors did this, but it was one of the worst decisions in Nike's history. And this is not the first time. I'm going to show you in just a moment. This isn't the first time this happened. But the board of directors decided to bring in a gentleman who used to work at eBay, ServiceNow. He's worked all over the place. But at the end of the day, his real background is in consulting. Red flag right away. CEO of eBay, a company that most people would call kind of a dead company for the past 20 plus years, red flag. And then he hopped on ServiceNow, which was just a growth animal, and anybody could have ran that company. Red flags all over the place with this gentleman, right? And he made a lot of bad decisions, and some of those we're going to go through in this video here today, right? But at the end of the day, that was a big mistake. But it's not the first time Nike's made this mistake. So Phil Knight was the founder of Nike. He led this company for about 40 years, from 1964 when he started it, from just being a very, let's call it niche kind of track-related company and running-related company, into being a juggernaut company, right? Think about Air Jordan, Michael Jordan, and becoming a global brand. And so he left the company in 2004. And the board of directors brought in this gentleman named William Perez, and he was the CEO from 2004 to 2006. Red flag. If a CEO is only a CEO of a company for 2 years, likely he did a bad job. Here's what happened. William Perez was brought outside the company in 2004. Oh, do we see a common thread here? They brought an outsider in to come run Nike. I wonder how this is going to end. They brought him in to succeed Phil Knight. Perez took over as CEO during a transitional period at Nike, the first time in decades that an outsider would take the reins of power at Nike. Though ambitious, Perez struggled to navigate Nike's insular corporate culture. The legacy employees at the time were way too focused on marketing, neglecting other vital parts of the business. Perez focused on shifting his focus toward improving global supply chains and operations. Still, he faced resistance from longtime Nike executives who didn't like the direction in which he was taking things. It went downhill fast as key Nike executives quickly lost confidence in Perez after a mere 2 years, especially as the company was marred by rising costs and stagnant profits. Oh my gosh! Are you telling me we're having deja vu? Isn't this fascinating, right? What Nike is going through right now is the same thing it went through 20 years ago. It's unbelievable. It's unbelievable, and it's fascinating that the board of directors made the same mistake, right? Where they brought in an outsider to come try to run the show, all to realize this was a huge mistake, and we need to find somebody in-house to run this show. Nike's a very special company, and I mean truly one of the most special companies we've ever seen in the history of mankind. What I'm showing you here right now in front of you, that's the top 25 biggest, best global brands, okay? These are sorts of brands you could go all over the world and say these brand names, and people all over the world, it doesn't matter if you're in New York City, or you're in Los Angeles, or you're in Alaska, or you're in Canada, or you're in Mexico, or you're in Shanghai, China, or you're in Hong Kong, or you're in Germany, if you're in Paris, you could say all these brand names, and the majority of people would be like, yeah, I know them, of course. Like Apple, oh yeah, I know Apple. Amazon, I think I know Amazon. McDonald's, oh, I think I know McDonald's. Like, of course, right? Nike's a very special company. And if you look here, there's only 4 clothing apparel related companies on here, right? One is Louis Vuitton, one is Hermes, one is Chanel, right? Those 3 are all big money companies, obviously high end. Nike is the only one who really caters to the masses. Like everybody can afford a Nike product, right? These are very special companies that need very specific CEOs to lead them. If those individuals do not understand the internal culture and what makes these companies special because they worked up the ranks, they cannot have these companies thrive. With that being said, these companies are so strong, the brands are so strong with them, that they can get through a bad CEO leading the company for several years. That's what's so special about all these brands. A bad CEO could take over, make a lot of mistakes, and they can still make it out to see another day. But if you don't bring somebody from in-house, I can tell you, you bring an outsider in to run Louis Vuitton, the brands are going to go downhill quickly. You'll see that likely within 24-month span. Same thing with Hermes, same thing with Chanel, and the same exact thing with Nike. Warren Buffett has a famous quote I remember from very early on in my investing journey back in like 2008, 2009. I remember hearing him say this, and I always found it fascinating. He said, I try to invest in businesses that are so wonderful that any idiot can run them, because sooner or later, one will. And if that's not the most truth, I don't know what is. It is so truthful. But the great thing is with these sorts of brands, they're so strong that any idiot can run them. That doesn't mean they're going to run them good. They can run them downhill, make a lot of mistakes. Somebody has to come in and clean up the mess, right? But they make it through. That's the important part, right? And that's what we've seen play out in Nike over the past few years. Now, the latest conference call, I listened to that today. A banger. The conference call was so good that I would say was even better than when Alex Chriss did his first conference call at PayPal. And I thought that was a very impressive one. This is another level up. The level of detail they went into is unparalleled. If you didn't get a chance to listen to that, 1000xstocks.com, listen to the Nike conference call. It was a masterpiece in terms of Elliot Hill just coming in and knowing what to do right from the go. Elliot Hill started out, and there's a lot of things that happened on the conference call. It was like an hour, it was a little over an hour long, right? He says he met with all the big suppliers of Nike. He said he met with the league leaders. I'm talking NFL commissioners, NBA commissioners, those sorts of folks, right? Roger Goodell, Adam Silver, the big dogs that run the NFL, the NBA, all the big leagues, right? He says he went to all the major markets Nike's in. He said he also spoke to the heads of all the major retailers, from Foot Locker to DKS, sporting goods. You go through the whole list of them, and including ones way outside the United States, all over the world, because it's not just like the United States are the only ones that have retailers, right? And he has, in the first couple months of being back, spoken to all those folks, right? And made them understand what Nike's going after, how they're positioning in the market, understanding what went wrong over the past few years. And he also said he's been very tied in, cheering for the company on the sideline, but probably knowing that they were making a lot of missteps, right? So he stayed kind of in the know of what was going on, and he was probably hearing a lot of bad stuff from, I can tell you, there's a lot of internal probably issues that were going on. Now, that he probably heard about over the past few years. So he was retired, but, a guy like that is still going to hear from all these other executives that, John's screwing up this, he's screwing up that, he's not doing this right, he's not doing that right? Now, retailers, he even mentioned specifically on the call, and I appreciate how candid he was about where Nike's at, the positioning, those sorts of things. But he said something very important here. He said, retailers feel like Nike turned their back on them. Who was the guy that called this out years ago? Years ago, if you follow me on the channel, Nike announced that they were going to go more direct. They were kind of moving away from the Foot Lockers and a lot of those sorts of companies. And at that time, I said, this is a huge mistake. This is a no-win situation. Nike's not going to win. Foot Locker's not going to win. None of these other retailers are going to win. Everybody's going to end up losing in this. Now, because the CEO came from that consulting culture, right? That's a culture of we write it down, we run numbers, and we say, oh, this sounds smart. Yeah, let's just sell everything direct. That's going to be a genius idea. We'll get more margin than if we sold to retailers, right? Huge mistake in the end. Huge mistake, because not everybody wants to go direct to the Nike app. I might personally have the Nike app and order stuff there, but most people aren't. They want to go to Foot Locker, they want to go to DKS Sporting Goods, they want to go to all those sorts of companies to go buy Nike products, right? If all of a sudden you start to hurt those retailers, right? Guess what those retailers are going to do? They're going to find other brands to go promote. They're going to say, oh, Nike's screwing us. They stabbed us in the back. Let's go promote Hoka. Let's go promote On. Let's go promote Adidas. Let's go promote blah, blah, blah. Whoever. They're going to fill that space with somebody else, right? So now, when somebody goes to their favorite retailer, where they like to buy shoes or clothes or whatever, right? Instead of Nike product being there, guess what? Somebody else's product's there. That's a no-win for everybody. I called this out, and sure enough, it's all played out. And look at all the retailers. They all got hurt by this. Nike got hurt by this. It was a lose-lose for everybody. But that's all reversing. Elliot Hill now understands on a very high level, these retailers are extremely important. So what they're going to be doing is now building their relationships with all these retailers instead of hurting them. This is something that matters significantly. Now, additionally, I posted this inside the Private Stock Group's Nike chat, right, which was obviously very active today. Very active day in the Nike chat in my Private Stock Group. Holy smokes, okay? I said, men and women's running is back to growth. That's big, right? And the CFO mentioned that around 25:30 roughly in the conference call, somewhere around there. Now, the reason that's so big is you got to understand Nike's faced a lot of competition from that running space. Additionally, Nike at its core is a running company. It's a running company. I know we think about Nike and we think about Air Jordan and we think about Michael Jordan throwing down slam dunks, right? And we think about maybe LeBron James, or like whoever the big athletes were of their day in basketball, right? But at the end of the day, Nike's core has always been running. If Nike's can't grow in running, there's big holes in the business model, right? Like they got big problems there. When Nike's growing running, they're back on the right track. And the fact that now in men's and women's running, as I said, they're back to growth in that space, I can tell you that is massive for this company. If they can accelerate over the next few years, then we're talking about the core of Nike's business is fixed. And I'm telling you, it's huge for Nike's business model overall, right? Additionally, Elliot Hill says they're moving the direct channel. So think of the direct channel as people going on the Nike app, people going on Nike's website to buy stuff. They're moving that to full price direct channel in 2025 and beyond. So no more like 50-50, because basically what he says is they've been discounting about half of the merchandise and then half selling full price, right? Which destroys Nike's margins over time, but additionally it destroys the retailers' margins, right? So when we talk about, the retailers saying they feel like Nike turned the back on them, it's not just because Nike wouldn't give them as much inventory, right, and as many products and key products and things like that. Additionally, if we want to take this a step further, right, if let's say Nike's discounting on the app or the website, right, and then let's say you're Foot Locker, what are you going to have to do? Well, you're going to have to discount as well. And next thing you know, it's a race to the bottom between Nike discounting product and then Foot Locker discounting and then all the other retailers discounting, and it's just a bloodbath. No one wins in that situation. I mean, you can say maybe the consumer wins if they want it, but it's also damaging to your brand, right? No one wins in that situation. So the fact that they're going to move the channel back to full price, in my opinion, is the best decision. The best decision they can make, right? And if the retailers want to do promotions sometimes on deals on products, let them do that. If they want to take hits on margin sometimes because they want to move a lot of merchandise, let them do that. And they want to do door busters and get people in the door, let them do that. But Nike, you don't personally be taking those discounts because all you're going to be destroying is your margin, your brand, all those sorts of things, right? And then putting your retailers in an impossible situation. So the moral of the story is this matters a lot more than I think a lot of people realize, okay? Now, listen to the conference call. They didn't really give 2025 guidance, but this is me just kind of reading through the tea tree leaves. Here's what it sounds like to me on how 2025 is going to look for Nike on the revenue side, okay? So I believe in this particular quarter, during this particular time period, it sounds like revenues are going to be down a lot. And the reason being is they're repositioning the brand, right? They're clearing off old inventory to get out of the channel and whatnot. So I would not expect any sort of revenue growth. It should be another big revenue down kind of quarter here, okay? Then when we start talking about the springtime, what that should likely be is revenue either down slightly or maybe even break even when it comes to revenue. That's what it sounds like to me. And what it sounds like to me is in the back half of the year, we get back to growth in regards to Nike, which will be a monumental moment that then they're back to actual revenue growth. Now, when we talk about revenue growth at full price too, this is going to be huge for the bottom line, absolutely massive. So that's the way it sounds like to me for 2025. So I have to position into the stock, right? And we're going to talk more about positioning into the stock and things like that. But I got to do that before they show the growth, right? Because by the time they show the growth, the stock price is likely going to be significantly higher than where it is today, right? Now, if you look at the latest income statement here, right, what's fascinating to me is how well positioned the company is set for once revenue turns, okay? So now with the company getting back to full price, right, and you're going to see gross margins explode higher, likely starting 2 quarters from now. You're going to see the net margins exploding higher two quarters from now, right? But they've brought down overhead expense quite a bit, and they're probably going to bring that down even a little bit more here. So we're talking about gross margins that will likely explode higher in the back half of the year, along with a much lower overhead base, right? And then once you tack on revenue growth on top of that in the second half, we're going to likely see the earnings per share skyrocket for this company in the second half of 2025 through 2026. And then I believe 2027 and after, we're going to get back to a much more steady 5 to 10% growth a year for Nike overall. But I think it's going to be a rocket ship ride the second half of 2025 through 2026. But once again, you could say, why not wait till second half of 2025? Like, if Nike stock goes down for the next 6 months, that's fine. I'll buy more and more shares, but I don't want to have to put myself in a situation where, because once you got to understand, once the cat's out of the bag and everybody understands, oh, Nike's back to growth, everybody on Wall Street's going to want a piece of Nike stock again. This is actually a beloved, loved stock, other than the last 2 years. Outside of the last 2 years, Nike is one of the most loved stocks in the stock market. So as soon as Nike starts showing those positive revenue numbers again, they're going to come flooding back into the stock, left and right, okay? Hey, it's Jeremy. I hope you really enjoyed watching that clip here today. What you're looking at in front of you right there, that's 1000xstocks.com. That's my advanced software that I've been working in the background creating for a long time. This software is so much more advanced than what others are presenting out there in the market. And as somebody that's been in the market 15 years, I want to create something that was simple, that had exactly everything I needed to make my judgments on companies, such as forward P ratios, 2-year out forward P ratios, price to sales ratios, forward price to sales ratios. I wanted the ability to be able to compare different companies versus each other. I wanted to be able to compare a Meta versus a Google versus an Apple and be able to see all those different metrics laid out all next to each other. I wanted a service that I could listen to conference calls right through and even be able to toggle and adjust the speed I wanted to listen to those conference calls. I wanted a service that I could search SEC filings right through. I wanted the ability to do that all in one service, and that is exactly what I've created with 1000xstocks.com. If you want to apply for access to this, go to the description area of this video. You can click that link and go ahead and apply for access to this. If you don't want to do that, you can go to 1000xstocks.com. Enjoy. All right, let's listen to Stephanie Link's top stock picks here, and I'll share my opinions and perspectives on them.
Portfolio manager at Hightower Advisors, as well as a CNBC contributor. She has her Christmas spirit on. She's basically wearing it on the air, Stephanie. However, as I said, the Grinch came early, and the question is there any chance of a Santa Claus rally come Wednesday?
Well, we are up 24%, Andrew, year to date. So we've had a really good year.
Very short term right now. It's early.
It sounds like it, but I want to keep it into perspective. We were up 26% last year, 24% this year. I actually think we could rally into the end of the year. And I think the winners are going to continue to win into the end of the year because you have portfolio managers that are underperforming their benchmarks, and they're going to just try to catch up. And I think the losers...
This is ridiculous. Into the end of the year, we got a half trading day tomorrow. We got Wednesday, the markets closed. Then the markets open Thursday, Friday. Then the next week, markets closed on Wednesday. And it might be another half day on Tuesday. I can't quite remember. There's hardly any trading days left. There's like a few trading days. Like, come on, like this is silly talk. I mean, a month ago at this time, let's say we were in middle to late November, it made sense to what's going to happen here at the end of the year. But I'm like, we got literally like 4 or 5 trading days left in the whole year. Like, this is silly talk.
Probably continue to lose too on tax loss harvesting. And so that theme has been kind of playing itself out in the month of December, right? The Mag 7 have really been the leaders. Technology have been the leaders, and just about everything else has not really kept up. But I do think you are going to see into 25 maybe a little bit more broadening out. Look, I mean, I know last week was wild with regards to Powell commentary.
Listen, in terms of tax loss harvesting, all the major tax loss harvesting is done now for this year. And the reason being is whenever the Wall Streeters are going to tax loss harvest, they're usually going to do it in the first 3 weeks of December. And the reason being, they could start in November sometimes, but usually it's the first 3 weeks of December if they're doing tax loss harvesting type moves, right? Stocks that have performed poorly and they need to get rid of. And the reason folks do that is because they usually take off the last 2 weeks of December, right? For Christmas and for New Year's. And so, therefore, if they need to make portfolio adjustments, if the funds need to make moves, they're going to make moves in those first 3 weeks, wash their hands of that, and then call it a year. And then they return after New Year's usually. So, this year, New Year's falls on a Wednesday. They'll probably still take that Thursday, Friday off, and then they'll be back the week of, what would that be, January 5th. Somewhere around there, January 5th, January 6th, they'll be back in full action there. So the moves have been made now at this point in time.
Very hawkish.
And any downward moves you really see in any of these stocks from here, that's just normal price action, down or up. The tax loss harvesting is done.
The close call of the cut that they just did, all of that was not great, and it led to uncertainty. It's the reason why the market pulled back. But one thing we did learn, we learned that they're focused on not only labor market, which is fine, but they're also focused on inflation. And the PCE, the core PCE number on Friday was okay. It's still high at 2.8, but it could have been a lot worse. And so that's why I think we're all kind of breathing a sigh of relief. And in addition, if you look at some of the other data that came out on Friday, personal income, personal spending, wages, all of that were up north of 5%. And that's good news for the consumer, which is 75% of GDP. So you add this all up, I do think you're going to see the Santa Claus rally. And even if we don't, can't complain about 24%.
Tell me what you think is really 25 portends, meaning if we're having this conversation a year from now.
Yeah, I think you're probably going to see not 3% GDP growth, but maybe something like 2.5%. But that is still pretty supportive of something like 8 to 10% earnings growth. And that's really what I care about as an investor. I think inflation is going to come down eventually as growth slows. So I've been in the camp that the reason inflation has been high or elevated is because we've seen above average growth. We're running at 3.2% GDP growth right now on top of 3.4 last year. So I don't think you're going to see that momentum continue at that pace because we just don't have that fiscal spend. But I do think you are going to see above trend growth given Trump's pro-growth policies, deregulation, lower tax cuts. So all of that up, I think, earnings running about 8 to 10%. I think that's pretty supportive of a broadening out in the market, not just a Mag 7, but I still like Mag 7 too.
Okay, so but outside of Mag 7, give us some names that you like.
Here we go.
Okay, so I would include Mag 7 and maybe Mag 8 if you put in Broadcom, right? I mean, the stock's up 97% year to date. It pales into comparison to NVIDIA, which is up 172%. But this company just told you that their custom chips, they are actually increasing their customer base there from 3 to 5. That AI service addressable market is something like 60 to 90 billion by 2027. That's 3 to 4 times as large as today. And they have earnings power of something like $11 to $12 a share. If you believe that, the stock's trading at 21 times. And I know it's had a heck of a run, but I do believe it will continue. Outside of the Mag 7 and in technology, I like Accenture. Accenture is actually only up 4% year to date, and it too is an AI and cybersecurity play. They just beat, they raised, it has an increase in operating margins. Their Gen AI bookings, Andrew, rose 144% in their quarter, year over year, and their cyber revenues grew double digits. So I think that one plays catch up. So I like some of the names that have momentum, but I also like some of the ones that have mean reversion into 2025, and we can talk about a bunch of other names too, if you like.
I'll take them. Give some stocking stuffers.
Okay.
Some stocking stuffer. The Accenture, that one could be intriguing. I might have to dig in on that one a little bit. You know what? Let me pull up 1000X. Let's pull it up right now and go ahead and take a peek. Alrighty, here's this Accenture company. So it looks like trailing 12-month P 30. 27 forward P, 26 2-year forward P. That's exactly what I like to see. The P's coming down as time ticks on. Wow. Trailing 12-month earnings per share growth 10%, and current year 10%, next year 10%. Dang. If they do that, that's pretty impressive. Revenue growth looks kind of laggy here, but supposedly this next year they're supposed to have a revenue acceleration, which is pretty exciting if you go from like 3% sleepy number to 6 or 7%. Because then if you go to 6 or 7%, then people start talking about maybe they're going to get back to double digits, right? Or something like that. So that's kind of intriguing. Gross margins in the 30s, net margins, very low double digits. Okay. This one could be interesting. Let's see. Let's pull up charts here. Let's pull up charts on ECN. I'd love to take a peek here. Ooh, see, it's very flattish, right, as far as revenue goes. So if they get back to nice growth, then we got something here. I'm going to have to dig in and see if there's something with this company, though. Gross margins 32% recently. Earnings per share was flattish for quite a while, but it looks like they're about to start a nice uptrend there. Free cash flow looks very stagnant. Operating cash flow looks very stagnant. Operating income looks very stagnant, but starting to head the right direction here. And shareholder equity is actually very impressive. That continues to go up very nicely. So I'll have to dig in there and see if there's something there.
Stocking stuffers, I love it. Rockwell Automation, that stock is down 6% on the year. And you and I have talked all year long about electrification and the energy transition that we're going to see over the next 2 decades. We're going to spend $4 trillion on electrification and this energy transition and automation between now and 2050. And Rockwell Automation is on the automation side. Their markets are bottoming. It has not participated with like the Eatons and the Quanta Services and the GE Vernovas of the world. But I think it will mean revert. They have a new CFO also who's laser focused on margins and profitability. I like banks. I like Bank of America. I thought Brian Moynihan's commentary on your show a week and a half ago was very encouraging in terms of better growth. They expect to see a little bit better loan growth, and deregulation will help M&A and activity. And I do think net interest income with the steeper yield curve will be the 2025 story. And these guys have about 60% of their revenues is that. So, and then also we get Basel III Endgame, which is the capital rules. As you know, I think they're going to be less restrictive. And Brian Moynihan is on record saying, I'm going to buy $20 billion of stock once we figure out what those rules are. And the stock trades at about 1.3 times book. And then finally, I like the gap. Because I do think it's a special situation turnaround story with the CEO, Richard Dixon, bringing in new management. They're gaining.
A lot of those ones just not interested at all. Gap, heck no. Bank of America, definitely not either. The issue with companies like Bank of America, well, that's one issue right there, right? But go ahead. Let's go to the search feature here on 1000X. Go to Bank of America. The issue with the banks, no one's ever willing to pay up for these guys. So they always trade at these like dirt cheap multiples, which is fine, but you're never going to command a big multiple on these. So if you're ever thinking like maybe someday we can get outside of a crash scenario, you're never going to command a big multiple. But in a crash scenario, no one wants to buy the banks anyways. So they just always are going to trade cheap. They're always going to look like dirt cheap stocks with a forward P of 12, 14, 13, something like that. And that is what it is. Banks, no. The only one that's interesting in the banking space really nowadays is SoFi, right? And that's because you really get the fintech side attached to it. And because they're so new age, they're so focused on, the millennials, the Gen Z, Gen Alphas,